As we enter the second half of the year, investors find themselves in an environment full of opportunity and extreme underlying risk. On the surface, and generally speaking, everything seems fine, but there are a number of underlying forces that threaten the financial markets. Today, I'm going to cover the opportunities, the risks, and explain how I'm investing for myself and my clients. Hi, I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. Let's talk market forces. Before I jump into my third quarter investment outlook, a reminder that this video is for educational purposes only and does not include any investment recommendations. Your portfolio should be customized to your personal investment expectations and your risk tolerance. If you're looking for personal investment advice or you want a free detailed analysis of your portfolio, contact me directly. This video is going to be split into two sections, just like the written outlook that is on my website. If you go to alpharockinvestments.com, click on Investment Outlook, or subscribe to my weekly market newsletter called Market Forces. You can get a copy of that. But the video is going to be structured just like the Outlook, split into two sections. I'm going to talk about the overall investment environment, primarily the risks, and then I'm going to jump into the opportunities and how I'm investing for myself and for my clients. So as we enter the second half of 2026, the global economy has proven resilient, and the AI capex boom now accounts for nearly half of U.S. GDP growth. This momentum has pushed the U.S. stock market indexes to over 100 new all-time highs over the past 3 years, dragging the famous Buffett indicator. That's probably the most famous stock market valuation metric that there is. It's pushed that into uncharted territory and historically dangerous territory. As stock investors watch their paper wealth soar, major shifts are happening beneath the surface. I'm going to talk about some of those now. And first, the end of easy money. For over 40 years, financial markets were fueled by low interest rates and cheap capital. Today, that era is officially over. The massive accumulation of sovereign debt across developed nations, especially here in the US, has fundamentally altered central bank policy. The U.S. government is now being squeezed by interest expenses that exceed $1 trillion per year. As existing debt matures and needs to be refinanced, a huge deluge of brand new supply could easily push long-term yields well above 5%. If this structural debt, if those pressures intensify, investors will need to prepare for the reality of financial repression. We could see central banks implement yield curve control, or the government could mandate a restructuring of long-term treasury debt, effectively forcing the extension of maturities or slashing coupon rates to keep the system afloat. The second risk I want to discuss is the AI hype cycle and the AI overbuild, the AI capex overbuild that we're seeing now in the economy. Easy money combined with the AI hype cycle has created a powerful momentum-driven market. As a risk manager, I think this historic bull market is in a very late stage, and I think it's incredibly vulnerable. Last quarter, I published a 3-part series entitled AI Snake Oil. To recap that entire series in a few sentences, I would say, while we believe that AI will undoubtedly be a transformative technology, its future does not belong to a monopoly of a few massive multi-trillion-dollar large language model companies. The real value of AI will manifest as 10,000 specialized tools integrated into our daily workflows. Models are already becoming smaller, cheaper, and more efficient. The frontier model bubble will burst, giving way to an era of specialized, cost-effective systems that prioritize actual enterprise utility over raw scale. For the average investor, the bursting of the AI bubble should be terrifying. Yet the crowd remains completely fearless. My job is to protect your wealth, not to follow the crowd. Unlike the minor corrections we've seen in recent years, the risk of a prolonged bear market driven by a combination of a recession, stagflation, a massive valuation contraction is very real. A decline of 30 to 50% wouldn't be unprecedented. In fact, it would simply be a reversion to the stock market's long-term historical mean. and the cracks are already forming. In the private credit and private equity markets, firms are systematically laundering volatility. They're keeping assets marked at par even when underlying borrowers are missing cash payments. Major interval funds are already beginning to restrict redemptions or sharply mark down their valuations. Worse, the corporate high yield market faces a massive refinancing cliff. The sheer opacity and hidden leverage within lower tier corporate and consumer credit feels eerily reminiscent to the lead up to the 2008 financial crisis. These assets and liabilities among private equity, insurance companies, and offshore reinsurance entities have formed a tangled web that can't be easily unwound as financial conditions tighten. Now, I want to talk about our investment strategy and how we're investing here at Alpha Rock for our clients. Insulating your portfolio in such hyper-connected financial markets is a massive challenge. That's exactly why we designed the Alpha Rock growth strategy. Our implicit objective is to seek positive returns regardless of market conditions. We seek to achieve this through an actively managed, highly diversified allocation across alternative investments, using both long and short positions to mitigate downside risk and to capitalize on market volatility. Because of these extreme concentrations and risks today, we have near zero exposure to large cap US stocks and traditional cap weighted index funds. We're also completely avoiding long-term, long-duration US debt, which remains highly vulnerable to structural inflation. Instead, we've positioned the portfolio where the real structural tailwinds are. Let's break down exactly how we're invested, asset by asset, and why. First up, short-term US Treasury bonds with 1 to 3 year maturities. Think of this as a defensive foundation for your portfolio. Because they're backed by US government credit and default risks are virtually zero, by keeping our duration short, we lock in reliable yield, right now around 3.5% per year, insulating portfolios from violent interest rate swings. It's our stable cash generator, protecting your principal and keeping our dry powder liquid and ready to deploy as new opportunities arise. Our second largest holding is gold. We're in the midst of a massive global shift away from fiat currencies driven by runaway government debt. Policymakers have a brutal choice. They can keep interest rates high to fight inflation, or they can cut them to save the bond markets. They're going to choose to cut rates. That means inflation isn't going away, and the purchasing power of your cash will continue to melt slowly. Central banks know this. They're buying gold at a record pace. Yet most traditional advisors and most investors are completely ignoring the precious metal. If the market finally wakes up and there is a rush into gold, it could send prices parabolic. Emerging and frontier market bonds are also an important part of both our growth and income portfolios. Emerging and frontier markets represent 85% of the world's population and 60% of its economic output, with growth projected to hit nearly 4% this year, miles ahead of developed markets. Thanks to strict fiscal discipline, these governments are getting credit upgrades, and default rates are currently under 1%. They offer an attractive diversification benefit because they don't move in tandem with US bonds, and a weakening dollar and other fiat currencies give them an extra boost of performance. Energy infrastructure is another place where we're invested, which can act as a volatility hedge and also an income generator. We invest in midstream companies that build pipelines and storage facilities across North America. They act like toll collectors, generating consistent fee-based revenue, regardless of daily oil and gas price swings. Plus, their long-term contracts automatically adjust for inflation. With the U.S. natural gas export boom doubling by 2028, AI data centers are starving for power, and the demand for this infrastructure is skyrocketing. Best of all, the structure bypasses the brutal K-1 tax forms, giving investors a clean 1099 at year end. We have a 5% position that is short the Mag 7 US stocks. We're shorting the Mag 7 tech stocks through an ETF. The AI hype has created a massive, unsustainable bubble. Big tech companies have transitioned from high-margin software businesses into heavy hardware companies burning billions of dollars on data centers and the chips that are in those centers. The problem, enterprise customers aren't seeing a return on the investment. They have zero profitability, and customers are starting to revolt over high costs. The entire AI ecosystem relies on NVIDIA and a few other chip manufacturers' hyperinflated valuations. If just one or two of these tech giants cut their spending, the whole domino line collapses. We believe this multi-trillion-dollar valuations are built on pure hype and not real profits. Uranium and nuclear infrastructure. Nuclear power is the only non-zero carbon 24/7 baseload power capable of meeting climate goals and feeding AI data centers. Nearly 40 nations have pledged to triple nuclear capacity by 2050. On top of that, regulatory logjams are clearing, and the World Bank just ended its 60-year ban on nuclear financing. This explosive demand collides with a severe decade-long supply deficit in raw uranium. As superpowers scramble to secure their grids, uranium prices have years of structural growth ahead, in our opinion. We're also holding natural resource equities. Companies that extract oil, gas, metals, and agricultural products offer an attractive opportunity in this environment. In a fractured geopolitical landscape where nations are scrambling to lock down supply chains, raw materials are king. But instead of buying the commodities directly, which is expensive to store and trade, we buy the producers. This gives us exposure to corporate cash flows, rising dividends, and a hedge against inflation. When traditional stocks and bonds struggle, these real assets may act as a resilient anchor for the portfolio. Next are rare earth and strategic metals. These elements are non-negotiable building blocks for electric vehicles, semiconductors, defense drones, and AI data centers. Here's the catch: trying to control 70% of the production and 90% of the processing. In the US, we are now aggressively funding domestic supply chains to break this monopoly. Because these metals sit at the absolute epicenter of global trade wars, prices will be volatile, but Western-aligned rare earth companies are positioned for a massive strategic upside as supply chains decouple. Collateralized loan obligations. To maximize high-quality income, we use CLOs, not CDOs. Don't confuse CLOs with the subprime CDOs that caused the 2008 financial crisis. CLOs consist of senior secured loans at the very top of the corporate capital structure, meaning they're first to be paid if a company struggles. Because these loans have floating interest rates, they actually protect you when interest rates rise. They're actively managed, highly diversified across hundreds of companies, and thanks to modern ETFs, retail investors can now access these high-yield, institutional-grade assets with daily liquidity. Finally, cryptocurrency and tokenization. Digital assets. We hold a dual allocation in Bitcoin Cash and Ethereum. Bitcoin Cash captures the original version of crypto, a secure, low-cost, decentralized global cash system that handles scaling right on its base layer without complex workarounds. Meanwhile, Ethereum is our play on the massive Wall Street migration to blockchain infrastructure and tokenization. Giants like BlackRock, JP Morgan, the New York Stock Exchange are already moving billions on-chain to automate payments and fractional ownership. As real-world asset tokenization accelerates, Ethereum stands as the undisputed foundational layer of the future financial system. In closing, a lot can be said about today's financial market environment, and there are an unlimited number of possibilities for the future. If there's one message that I want to get across today, it's that missing out on a high-flying stock market is okay. After all, you missed a huge party in Las Vegas last night, too. So what? Your goal isn't to attend every party. It's to protect and grow your wealth modestly over time, because slow and steady wins the race. My full investment outlook is available to all subscribers to my free weekly letter, Market Forces, at alpharockinvestments.com. Please like this video and subscribe to my channel. It helps me reach new viewers. If you have a question or you'd like to meet or talk with me in person, contact me directly. Links are in the description.